Hello, folks. Welcome to this episode of Rich Insights. I'm Don Rich, head of investments for Esoterica Capital. Today's topic is it's hard to keep a bad market down. Now, I know I seem like I'm on a tirade this week, but I assure you I am not a perma bull. It's just that to me, the data, the evidence is so overwhelming right now. I just want to highlight it from a variety of different angles. Now, first and foremost, of course, we still have the virus, right? The coronavirus is still very much in our face. We can't ignore that. So we have to be worried about the resurgence of the coronavirus, right? Or second wave of the coronavirus. And we have to be worried about the second order effects from the first wave. And what I'm talking about there is again, maybe this wave of small business bankruptcies coming at us, the downgrades, the corporate and credit downgrades, loss of investment status, and so forth. All of these things are likely coming at us, and yet we have equities trading at or near all-time high prices. This just doesn't make any sense to me. All right, let's go to the charts here to start with. Start here with the coronavirus. This is a chart I borrowed from CNBC, an article on CNBC, and what you can see here is a very concerning and disturbing trend here in the U.S. in terms of the number of confirmed cases. Now, again, part of this increase in confirmed cases is due to the fact that we're testing more. There's no doubt about that, and that point's been made out, been highlighted many times. But you see the highlighted states here, again, the big ones, the most influential to the U.S., California, Texas, Florida. Now, New York's no longer a major concern, but the other three major U.S. states are all increasing dramatically. This has to be a concern for markets just in isolation, right? But I'm really not even getting that excited about that, right? I'm not trying to belittle the human consequences of the coronavirus. What I'm talking about, again, is our assessment of the economic impact of the first wave of the coronavirus. Let's take a look at this. The IMF chimed in today. The IMF downgraded its growth predictions for the year here. These are the 2020 growth projections. You can see they were downgraded. The red is the April forecast, and then the yellow is the new forecast. So global contraction is now expected to be on the order of 5%. Now, what I find amazing about this chart is, again, we have the last 40 years here. We're looking at the last 40 years of global growth. We haven't seen anything even close to what the IMF expects we're going to experience this year. Here you see, the 2008, the 2001 slowdown, the 91 recession. We just keep going back and back to times we thought, were slow growth. They don't even measure up to what the IMF thinks we're looking at today. And to add to that, notice the writing on the bottom here. The IMF also cautions about the disconnect here between market sentiment and economic reality. They just seem to be so far apart right now. Maybe I'm just telling you that to appease my mind, or to let you know that I'm not the only one that thinks that things have gotten a bit crazy right now. Now, that begs a bigger question. How did we get in this mess, if you will? How did we get such a run-up in prices? Well, we've had this huge influx of liquidity, right? And it's through all these government programs. They call them fiscal programs. The stimulus plans, right? The stimulus checks, payroll protection, and so forth. And then, of course, we have the monetary stimulus, right? Coming from the central banks, the Fed, with all their plans. And so when you have all these emergency facilities pumping liquidity into the system, it has to go somewhere. And for the most part, it is just driving up prices right now. And it's resulted in just risk appetite going nuts. And we had a great example of that just recently. Back to the charts here, we have a 100-year bond issued by Austria, a 100-year bond that is paying 88 basis points. 88 basis points here, right? A $2 billion bond issue for 88 basis points for 100 years. it is just like people, investors, are tripping over themselves to put money to work, to give it away, to lock in nearly a zero rate of return for the next 100 years. Wow, that is screwed up. But you can't blame the governments for trying to take advantage of it, right? Who's buying these bonds, right? It's most likely life insurance company and pension funds who have to hedge their long-term liabilities, right? They have a huge demand, almost an insatiable demand for these long-dated treasuries. And so you can't blame the governments for issuing them. The only thing I wonder is how long before somebody surpasses the 100-year mark. Hell, if 100 years works, why not 150? Why not 250? Let's go back. I believe it was the UK government issued some war bonds during World War II that were perpetual bonds, no maturity to them. Of course, they could call them, pay them off at any time, but we haven't seen anything like that forever and ever. Generally, like I said, a wartime situation is the only thing that can motivate such an extreme event. But this excessive risk taking, right? It's not only with the century bonds, it is everywhere, right? The disconnect that we're seeing right now really boggles the mind. Next, I want to go to future profit expectations versus the S&P 500. So here we have a chart of the last 20 years. Again, we're using aggregate profit estimates for the next 12 months. That's our brown line here. And plotting that against the S&P 500. And you can see for the most part, they track each other fairly well. If profits are expected to go down, right? If earnings are expected to go down, profits are going to go down, prices should go down. Right now, prices going straight up, profit in earnings expectations are going straight down, right? And in fact, as I look at that chart, it seems to me that we have to be at or near the largest discrepancy ever before. Again, that's what I'm talking about in terms of the disconnect. I've showed you many times, we have PE ratios that we haven't seen since the dot-com bubbles. So this profit chart was really just another way of demonstrating that same thing, right? The prices versus earnings, profits, any other measure, right? They're just a complete disconnect right now. Now, so we talked about the Austrian bond. We talked about the U.S. profit situation. Now let's go to interest rates for a second. I got an interesting chart for you on interest rates. This is foreign ownership of U.S. Treasury debt, right? Who's buying our bonds? And what we can see is that foreign ownership has fallen dramatically. It has been melting for years and years and years, and it's fallen dramatically. All right, let's talk about this for a while, because this could have some interest rate implications, right? Your gut reaction would tell you, if we don't have as many buyers, well, interest rates might go up in the future. Right? All right. Let's work through that for a second. Well, first of all, a big buyer of U.S. Treasuries in the past has been what's called petro recycling dollars. Right? These are countries that we buy oil from. We pay them in dollars, and then they just reinvest or recycle those dollars back into U.S. Treasuries. And of course, we had this whole energy renaissance in the U.S., where the U.S. was becoming more and more self-sufficient in terms of oil production. So we had fewer recycling dollars. Right? That's part of what we're picking up in the chart. Now, the other thing, of course, is just oil prices in general have come down. So even if we were still importing the same amount we did before, we're paying them less. We're paying the oil-producing countries less, and so they would be recycling less dollars, right? That's the second thing to consider here. And then there's also the trade implication. Now, if you trade in dollars with a country like China with a fixed currency or a semi-fixed currency, they try to get rid of the dollars as quickly as they go in. They're called trade recycling dollars. And of course, with the big drop off in trade activity due to the coronavirus, we're seeing less and less of that. But the big thing here that we're picking up on the chart, you notice that this thing started here about the time quantitative easing picked up. All right. So what we have right now is a new shooter in town, right? Who is replacing all these foreign buyers of Treasury? The Fed, right? Quantitative easing. Seems that we have unending and ever expanding amount of quantitative easing. And this is giving rise, people talk about zombie companies, perhaps zombie markets, zombie countries, maybe even, right? Zombie countries, right? It's the disciplinary role that the market normally serves is going by the wayside. The excessive risk appetite has just gone nuts. That investors are willing to take essentially any risk in hopes that they'll get paid for it, right? They don't demand appropriate compensation. All right, so again, I wish I had better news for you. As I continue to look at these charts, we just have this disconnect, the detachment of reality from prices as we see them today. You should adjust your risk profile in accordance with this. It doesn't mean that the disconnect is going to correct immediately. It could last for some time, but it will correct at some point. Fundamentals will reinsert themselves. And when that day comes, you want to be prepared. All right, so that's our message for today. I'm Don Rich. I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.